Hello, everyone. It's Monday, April 27th, 2020. I'm Dan Veru, and I hope that you're all healthy and well as we continue to be in lockdown mode from the coronavirus pandemic. Well, it certainly has been an extraordinary period of time. Obviously, the month of March and the first quarter showed extraordinary and historic weakness in all financial markets. But I firmly believe that that liquidation phase for the stock market is behind us, and that hindsight will prove that the late March period was very likely the low for stock prices and for Treasury bond yields as they had just gotten to historically low levels. Since that period of time, the stock market has had an extraordinary rebound, probably one of the best on record. The markets have appreciated over 20% since that late March bottom. And clearly a combination of modestly better environment as the pandemic seems to be cresting at this point and getting better in certain geographies of the country, but also because of the extraordinary level of stimulus that has been put into place. They always say that extraordinary times call for extraordinary actions, and it's been a 1-2 punch of monetary and fiscal policy by policymakers in Washington. From a fiscal policy standpoint, Republicans and Democrats have come together and have passed extraordinarily large bills aimed at helping those people most affected by the shutdown of the U.S. economy. Separately from that, there has been an extraordinarily large amount of stimulus on the part of the Federal Reserve. Normally, the Federal Reserve sets financial policy, interest rates, those sorts of things. But through programs called quantitative easing, they also have the ability to buy bonds. But normally, those bond buying programs were restricted only to U.S. Treasuries. They've dramatically broadened that mandate to buy high-grade corporate bonds, high-yield corporate bonds, municipal bonds, and mortgage-backed securities, all with the intent of providing liquidity and capital access to those companies that really needed it, into segments of the market like the mortgage market that weren't functioning properly as well. Obviously, what's gone on is really going to hurt many municipalities in a huge way. The municipal bond market has to be open so those municipalities and states can have access to capital as well, because unlike the federal government, the state of New York, the state of California, or whatever state can't print it, doesn't have its own currency and can't print it. We're going to see economic statistics and measures of unemployment that are just going to be of a historical nature. And as one strategist I thought made a very good point when he said that it's tough for the data to get worse when it's the worst on record. And that's where we are right now, that these are the worst economic statistics on record, and it's a byproduct of stopping our economy dead in its tracks in an effort to quell the spread of disease and to keep the pandemic more at bay. So that data is going to be very, very bad for the next few months, in my opinion, even after states begin to announce restarting the economy. This is not going to be a sharp resumption in business activity or spending activity on the part of people, because the states are going to phase these programs in, and the reopening of the states in a slow and measured manner to make sure that there isn't a high level of reinfection on a going forward basis. A sharp V-shaped type of recovery, I've argued, is definitely not in the cards. But we are definitely in a period of time right now where I would anticipate the markets could consolidate a bit, will sort of bounce around a little bit, and we're in probably a 3 to 6 month period of time as the market begins to base and looks towards 2021 when activity should rebound again. I anticipate the economy will likely bottom in the third quarter of 2020. We'll see evidence of that rebound probably sometime during the third quarter and into the fourth quarter. But stocks will likely price this rebound ahead of that. I think that's what they're attempting to do right now. So, speaking of stocks, I'm very heartened by the fact that the markets have found levels. We're starting, and we're still relatively early in the reporting season. I don't believe that anybody is buying stocks now because they think the current quarter or the guidance that companies are giving today is really going to be terribly meaningful. But I'd like to introduce the concept of normalizing the earnings. This has been such a dramatically sharp drop-off that you really have to, without looking at the other side in terms of what the rebound can be, really makes the numbers very irrelevant and is obviously going to make the stock market, as measured by the S&P 500, look very expensive. But I want to point out a couple things. First of all, when it's referred to the price earnings multiple on the market, that's the market in its aggregate. And I'd like to have everybody consider that this is the time to look for individual stocks. That perhaps the era of passive investing, where you just buy an index and hold that index, those opportunities probably are not going to be as good as looking for individual stocks in distinct sectors that have the best opportunities, because the opportunity set is clearly narrowed, and it's our job to look through those sectors and those companies that have the best possible returns on a going forward basis. So how are we doing that? Well, I and my portfolio managers and analysts are meeting more frequently than we ever have before. We're talking to policymakers in Washington, corporate CEOs, and really end-to-end customers as well, to get a feel for what is actually happening in the economy and where the best opportunities will be. We only are looking, those who are most negative right now are only looking at the door closing, but for every door that closes in terms of opportunities for certain businesses, another one opens up, and that's actually what we're looking for. So we've come to the conclusion clearly that the two most important areas right now are healthcare and technology. Healthcare is of particular importance because it's how we are going to solve this pandemic. Yes, there's been incredible work at an extraordinarily fast period of time for the discovery of various vaccines, and I'm very confident that results and progress will be made on that front, but that's still likely a year away before we'll have a generally available vaccination for COVID-19. However, that doesn't mean that there aren't opportunities within healthcare. Specifically, we think a lot of the companies that make the equipment for testing is extraordinarily important, whether to see whether you have the virus, or new tests that come out to see whether you've had the virus and to see what your immunity levels can be. That's all going to happen in the testing market with very sophisticated equipment, and we've focused on some of those companies as well. We also think the healthcare insurance providers is also an area that will work out quite well, simply because a lot of the more routine types of procedures are not being done right now, so they're not accessing the markets for that. And the outlook for the profits within the insurance sector look quite good. It could be one area that really is a standout, where in fact the numbers that could actually go up and not down, unlike many other sectors. The other area that continues to be very important is the technology sector. We think that area will continue to be a driver for future growth. Obviously, technology has been extraordinarily important while we've all been home. The 45 employees and partners at Palisade Capital are all working remotely, and it's the application of the technologies that we've put into place to allow our people to function, and it's been functioning extremely well. I think that opens the door for many different tech providers. And then I'd also talk about the convergence of healthcare and technology as well. That's really the area of telemedicine, which I think is going to be an emerging opportunity as we go forward. And I think that there are going to be a lot of different ways that we work and function when this is all over. Certainly, our new normal will be very different from the old normal. And again, that will create new opportunities for different businesses to prosper in that sort of an environment. And that's exactly what we're focused on right now. In the near term, technology and healthcare have done extremely well at the expense of some of the industrials and financials and some of the other areas of the market. While financials has been the financial space, namely the banks, has not been a good place more recently, some of the stocks have just gotten down to levels that just make them extremely attractive. Because again, banks entered this financial distress period with extraordinarily strong liquidity and balance sheet strength, unlike the financial crisis. And we're confident that the best operators are doing everything they can to position themselves well going through this period and looking towards the other side. The retail sector right now, many retailers are completely shut down, but that doesn't mean there aren't opportunities there. Certainly the companies with online capabilities are much more attractive than the physical stores, but we don't want to write off all the physical store companies either. There'll be some very selective opportunities in that area as well, and we're watching very closely for that also. So to kind of net it all out, this is going to be a stock picking market. That's an environment that Palisade's very comfortable operating in. It's very difficult to just want to sell everything, get out of the market. We don't think that that's what you should be doing. However, the indexes may not be the place to be on a going forward basis, and we welcome that because we can be tactical and opportunistic in finding the best opportunities. We did receive some questions earlier last week, and thank you for submitting your questions. I have one question asking what groups of specific stocks that have overreached on the downside due to the coronavirus pandemic, and where would you look for value? Well, that's a really good question, and it gets back to the point I was making earlier about normalizing earnings. If you take a banks, the major banks have mostly reported already. They took extraordinary levels of charges against potential losses. That obviously cuts into the near-term earnings, but as the economy begins to recover, some of those reserves will come back into earnings. Those stocks are down a lot. Many banks are near book value, and some are even close to tangible book value as well. So that's an area where you definitely want to have some exposure as things begin to normalize. Another investor said with investor sentiment still bullish, But you have poor technical signs within the metals market, the platinum and copper to gold ratios. Metals and commodities in general are still weak, and there's not been any change in the leadership. And with the markets above their valuations right now, is that a warning side for the market? Certainly, the base metals are a good indicator of economic activity, and it's no secret with global production levels at a near standstill. Those metals are going to be reflective of the current environment, but I'd watch for those groups to begin to show some life as industrial production begins to come back. Just today, Volkswagen announced that they'll be rehiring thousands of workers to their manufacturing facilities in Germany. Obviously, Germany did a great job managing through the pandemic, and they're beginning to rehire workers. So I would expect that we'll start to see the metals markets start to show some signs of life. Another question relating to our debt level to GDP. I think that it's clear that we are financing a lot of this current activity by borrowing from the future. There will be a day when we're going to have to pay back some of those bills. I don't think we're close to it. I want to point out, too, when looking at the actions of the Federal Reserve, it's very important to note that in taking on some of these, some of the assets that they're taking on their portfolio, they will actually make money for taxpayers as part of that, because assuming that there are no issues around solvency with the debt that they're buying, they're going to earn a return on that capital that they're deploying in those bonds, and that money will belong to taxpayers. The other spending, in terms of paying people while they're at home, it's the right thing to do in the short run. We have to support small businesses because we have to have those businesses in place so they can hire people back when things are better. I don't think policymakers are going to focus on this for at least a year before we go back, but certainly down the road there will have to be some reckoning in that regard. A client asked how I would expect the market and the economy to react to a sudden miracle vaccine. I mean, boy, I pray for that every day so no one has to suffer. That would be an incredibly positive event. I think it's not likely because I don't think that a miracle cure comes out overnight. There still has to be testing to be sure that vaccine is safe and efficacious. But that would have a tremendous impact because really what we'll be lacking is people being comfortable being out in larger public gatherings like we're used to doing. Another client asked a question about the meatpacking industry, and this is something I am watching quite closely. We certainly don't want to have shortages of beef or pork products, as many people have gotten sick in packing facilities around the country. I'm hopeful that is not something that's going to have a lasting impact on the supplies of beef and pork, but it's definitely something we want to be mindful of that. Another client asked, from here, if we have another major drop, what do you think would be the cause of it? Well, again, we're in this period of time where I would expect the stock market's going to pause and probably trade lower. I think a different cohort of stocks will trade lower in that sort of sell-off than the broader liquidation phase that we've just came off of. I don't expect the markets to go back to the old lows simply because the level of stimulus that's in place right now probably keeps that from happening. But if there was another announcement of reinfection rates rising or something else about this virus that we don't know that can harm people, that would certainly be a negative and a cause for concern, because then you'd be sort of back where we started from already in terms of solving this problem. Another client asks about if there are any individual stocks focusing on COVID testing and or vaccines, and that's a great question. We've been overweighted healthcare, and rather than name individual names, we are specifically focused on those companies that are involved in the testing, as I had mentioned earlier, and we've added a stock that's involved in the supplying of products that are used in the production of vaccines. So we're not necessarily betting on a winner or a loser. We're hopefully going to benefit regardless of which company comes through with a vaccine that works. Another client asked about manufacturing, and once again, focusing on the supply chain. Boy, that's really an outstanding question. And long term, and we've been talking a lot about this as a group, I think that a lot of the industrial companies hold appeal. I think a lot of the domestic manufacturing companies, or companies that have begun to move production back to the United States, could benefit in the long run. And generally speaking, I anticipate that we are going to see a move back of the supply chain from foreign countries to the United States, or certainly leaving China as, not necessarily leaving it all together, but certainly having multiple sources of products. One thing we've learned here is the supply chain is fragile, and you definitely don't want to have it all in one place. So I would anticipate other parts of Asia will be attractive, but I also think the United States will be very attractive. We have energy products here, natural gas and oil that can power plants, and obviously we'll have some slack in our workforce as companies look to deploy people and get them back to work. So I think we definitely can see companies begin to bring back their supply chains to areas where they can both track it better and know it's going to be there. So again, all really good questions. I'd like to briefly mention that now that we're all sort of stuck at home, this is probably a good time to review important planning documents that you may have put off. No one likes to review things like wills and trusts and all those kinds of things. As you know, Palisade has made a substantial investment in technology and people, most notably bringing in Lorraine Salvo as our financial planner. She's available at your disposal to talk about anything that might be on your mind. This is a good time to review those documents while we're all at home and perhaps cleaning out closets and reorganizing things. It's a very important time to make sure that these things are focused on as well. All of us at Palisade are here to serve you. We're here to help you. We're here to answer your questions. And if there's anything at all that any of us can do, please feel free to reach out. I'm going to be utilizing video conferencing a little bit more and getting more thoughts out as things have begun to normalize. And if you have any specific questions, feel free to reach out to me. Thank you very much, and have a great week.
The information contained in this webcast reflects the views of Palisade Capital Management, LLC, as of the date of its original broadcast, and such views are subject to change without notice at any time. All information provided in this webcast is for informational purposes only and should not be considered investment advice or recommendation to purchase or sell any specific security. While the information presented herein, including information obtained from third parties, is believed to be reliable, no warranty is made concerning the accuracy of such information. There can be no guarantee that any forecast discussed in this webcast will be realized. Consult your financial advisor before making any financial planning or investment decisions. Past performance is not a guarantee of future results.